Good afternoon and welcome to the March 27th edition of Office Hours. My name is Dr. Tisa Silver Kennedy. I'm the founder and executive director of the Maryland Center for Collegiate Financial Wellness, and I thank you so much for joining us here today. As with every edition of Office Hours, I'd like to tell you a bit about the Maryland Center for Collegiate Financial Wellness, then issue a quick disclaimer, some updates, and then I'll jump into answering your questions about student loans. And we've got quite a few, especially since there's a really important deadline coming up on April 30th of this year. So let's dig right in. The Maryland Center for Collegiate Financial Wellness was founded in 2021 with a vision for all college and career school students in the state of Maryland. And that's for them to be able to achieve these 6 pillars of collegiate financial wellness. Those are being creditworthy, ready, resilient, empowered, successful, and thriving. If you'd like to learn more about the mission and vision of the center, you can visit us online at mccfw.org. And before I get into the questions, I just want to share a quick disclaimer about office hours. It's presented for informational purposes only. The information presented does not constitute personal, legal, or financial advice. We do our very best to give you the most up-to-date information on student loans, but if you've been paying attention to this space for the past few weeks or even the past couple of years, you know that lots of changes are taking place. And with all of that information, it's important that you observe what's going on, but also make sure that you take inventory of your personal situation. That includes your student loans, your household characteristics, tax filing status, and all the things that feed into helping you make the most strategic decision possible when it comes to repaying your student loans. So now that that's out of the way, I want to share a quick update and then we'll jump into the questions. As for updates, of course, we are seeing more public service loan forgiveness victories. We've got some special projects going on in Baltimore City and Prince George's County through the No More O Less project, and that project has crossed a milestone of $700,000. We launched in October of last year and hosted our first set of in-school events in November of last year, and we are on our way to $1 million. I think that we're actually going to reach the $1 million mark next week. So congratulations to all of those PSLF victors. We thank you so much for your public service, and we're glad that we could be a part of helping public service loan forgiveness work for you. For other people who are wondering about forgiveness, it's not just for public servants. There are also options such as income-driven repayment. And speaking of IDR, we're coming up on a really important deadline of April 30th of 2024. Some people will need to take action to make sure that their loans are included in a special program called the IDR Adjustment. This is basically a way for people to get as much credit as possible toward loan forgiveness through income-driven repayment. And any credit earned through income-driven repayment can also be applied to public service loan forgiveness for people who work for qualifying employers. So there's a lot going on, and you want to make sure that you take every appropriate action by April the 30th before these most generous benefits disappear. The last thing I wanted to do is just give a shout out to the Cash Campaign of Maryland, because they hosted Money Power Day this past Saturday, March 23rd at Poly Western in Baltimore, Maryland. It was such a fabulous time. As you can see from the picture, Team McPhew was well represented and we had a ball. We were able to participate on a panel about planning for and paying for higher education. So it was a really good time. So definitely kudos to the team at the Cash Campaign of Maryland for putting together yet another stellar event, the largest financial fitness fair in the state of Maryland. So thank you so much for inviting us at the center to be a part of it. Before I get into the questions, I can't mention Baltimore City without mentioning the tragedy of the Key Bridge collapse. No words. I have no words, but I can just say that here at Team McPhew, Baltimore is very special to us. We do a lot of work in the city with schools, helping educators and other public servants get access to student loan benefits. As a matter of fact, part of my team is in Baltimore City today. So it's a very special city to us. We're very connected there, and we just want to send out so much love to everyone who is affected by that Key Bridge collapse. We are just keeping you in thought, lifting you up, and sending our best wishes for recovery, and also condolences to the families of those who lost their lives in that tragedy. Now, I want to move on to our questions. Our first question is, has anyone had their December forbearance counted? Should I just take myself off forbearance and give them another payment that I don't owe so that I can be done with it? So let's get to the answer here. When it comes to forbearances, there's a difference between an administrative forbearance and a forbearance that you requested for yourself. This particular person was placed into a forbearance for October and November. Their current status is that the month of December is listed as ineligible. They've got 119 payments because the count has not been updated, and they're supposed to remain in forbearance until the count gets updated. So, to answer this question, there are a lot of people who have been affected by late notifications about, when their payments were due. They might have been told a payment amount that was totally wrong, or experienced other types of billing errors. And for those people, they were placed into what's called an administrative forbearance, and they'll remain in that administrative forbearance until the issues are resolved. The key difference here when it comes to credit has to do with what kind of forbearance they're placed in. An administrative forbearance is not a forbearance of your choosing as the borrower. And since it's not your fault, the time during that forbearance is set to count while we're in this IDR adjustment period, because you didn't ask for the forbearance. The forbearance was more of a necessity so that your servicer could work out whatever issues are causing the problems on the back end. So as far as we know, any month spent in an administrative forbearance will be credited toward loan forgiveness, whether that's through income-driven repayment or public service loan forgiveness. But just rest assured, you're not the only person that is in that situation. There are a lot of people who have these billing errors, who have just been placed in that administrative forbearance to give their servicer some time to figure it out and come to a resolution. All right, let's get to our next question. This is about consolidation. If I wait for my consolidation to be approved and processed and then certify my prior employment, as a result, all of my loans will get credited with 130 payments. So definitely need some more information before I can answer that question, but I can tell you right away that this question is about public service loan forgiveness. So as a bit of background, this borrower has 7 loans that are with Mohela, and they have estimated the progress that those loans have toward public service loan forgiveness. 3 of those loans will be at 130 payments once remaining employment dates are certified from 2014 to 2017. And then they said that 4 of the loans are at 80-ish payments. So I can tell you this is about public service loan forgiveness because they're talking about employment dates being certified. And the only program you need to certify your employment for is public service loan forgiveness. With 3 loans at 130 payments, that means that those loans would be set for approval because we're looking for a qualifying payment count above 120. That's what it takes to get approved for PSLF. So if this person is going to be at 130 on these 3 loans, then these 3 loans would be forwarded to discharge. The remaining 4 loans that had 80-ish payments, we don't know what the ish is for, but we know it's 80-ish payments, they would have at a maximum 40 more months until they get approved for PSLF. So this situation of having different sets of loans with different numbers of counts is common for people who took out loans for different degrees or for people who started a degree program, then took some time off and then went back to finish. And right now, during this IDR adjustment period, there's a way to consolidate these loans and get them all on track for forgiveness at the fastest pace. So, originally, when the limited PSLF waiver was announced with this benefit, that consolidating these loans with different repayment timelines would result in the consolidation loan getting credit for the oldest, the amount of history attached to the oldest loan in the portfolio. The recommendation was that you consolidate your loans first. And then after the consolidation loan dispersed, submit your PSLF application. But now that more time has gone by and we've seen this process work many, many times, the timing is truly a matter of preference. So if you have these, direct loans with differing amounts of payments, you could go ahead and apply for PSLF first. But the suggestion to consolidate has to do with bringing all the loans onto the same repayment clock so that when the count is conducted, they will all be on the same page or the same clock toward that 120 count that we need to get the debt discharged completely. I still lean on the side of consolidating first, just because, that's how it was introduced to me in the fall of 2021 when all these changes came about. But you could, do them both at the same time. Both applications are available online at studentaid.gov. You'll need to log in to access the applications. But if you have loans with different amounts of repayment history, or some loans that are not eligible, they might be Phelps or Perkins loans. If you want them to be considered for PSLF, then you'll need to consolidate them. And you can consolidate them online at studentaid.gov. The process will probably take about 45 to 60 days for that consolidation loan to disperse. And by that time, if you submitted your PSLF application, Mohela should be well on its way to verifying your employment. I'd strongly suggest that you use the electronic version wherever possible. When it comes to PSLF, you know that if you send in a paper application, you could be looking at 90 business days as your wait time for receiving a response. And if you made a mistake on that paper form, then it would take you a really long time to learn that you were rejected. Then you'd have to submit another one and perhaps wait another 90 business days for an answer. With the electronic signature, we have seen people getting their accounts updated within a matter of days, like within the same week. If you send a paper application in, that's just not possible from what we've seen. So we're strongly encouraging everyone who is verifying their employment to go with the electronic signature option. Let DocuSign do its job and just remove all of the hassle of physically taking a piece of paper to somebody, waiting for them to sign it, getting it back, mailing it or faxing it to Mohela. Just use the help tool at studentaid.gov/PSLF, and DocuSign can take care of the rest for you. All right, let's move on to our next question. Is public service loan forgiveness even a possibility here? That question leaves a lot of room for interpretation. So of course we had to get some background. Let me share that with you. So this is someone who's asking for their parent. Their parent actually worked for a university for 10 years, doing some research in partnership with several nonprofit organizations. The work that the parent was conducting was primarily on site at the nonprofit organizations. So those are good things to know, but there are a couple more things that we need clarity on before we can determine if PSLF is a possibility here. With public service loan forgiveness, the eligibility of your employment is not about your job title or even the kind of work you do. It's about the type of organization that you work for directly. So for PSLF to be a possibility here, we need to know the organizational type of the university. Is it a for-profit university or is it a not-for-profit university? And we also need to know whether this position was directly held with the university or if it was like an independent contractors arrangement, because unfortunately, public service loan forgiveness does not apply to independent contract relationships, or even someone who is a contractor that's not directly employed by the qualifying entity. So if the parent in this situation worked for a nonprofit university or a public university, and they were a direct employee of that university, then PSLF would definitely be a possibility here, because we know that the employer qualifies for public service loan forgiveness. Generally speaking, universities, community colleges, they're qualifying employers for the purposes of PSLF, because most of them are public universities, or community colleges are public, or they're nonprofit private colleges and universities. So most of them do qualify for PSLF as employers, but you want to make sure that you get the employer ID number for the university where your parent worked. Have them go to studentaid.gov/PSLF and search just to make sure that the employer is a qualifying one indeed. And once they've confirmed that the employment qualifies, they can go ahead and submit that PSLF application online at studentaid.gov. And again, please take the electronic route. You can go electronic just by having the email address of a person who can verify your employment. And again, let DocuSign do what it's meant to do. And I just wanted to show you all where to go so that you can verify whether an employer qualifies for PSLF. This is online at studentaid.gov/PSLF. If you scroll down, you'll see a blue button to apply, and then there'll be some text for you to search for a qualifying employer. And after you click that text, then you'll be able to see that you can click the search button, enter the EIN, and go from there. All right, next question. I consolidated 5 loans for public service loan forgiveness. Why do I have 2 loans now? One subsidized and one unsubsidized. I thought consolidation meant that I would have 1 loan. Well, you do have 1 loan, but it's split into 2 pieces. So what happens with consolidation is that the structure of that new loan depends on the types of underlying loans that went into the consolidation. So if the consolidation loan includes subsidized loans and unsubsidized loans, your loans will still be consolidated, but they'll be kept in 2 parts. One part will keep all the subsidized loans on one side, the other part will contain the unsubsidized loans. I imagine this is done because the difference between those 2 loans is that with subsidized loans, there are some periods where interest will not accrue. With unsubsidized loans, interest accrues quite frequently, pretty much all the time. So when you consolidate the loans together, it's helpful to keep the subsidized portion and the unsubsidized portion separate because there may be some conditions in which the interest subsidy would apply. And if that's the case, the subsidized portion of your loan would stop accruing interest, whereas the unsubsidized portion of the loan would continue to accrue interest. So if you have multiple loans, like 10 loans, and you consolidated, but now you see 2, that doesn't mean that the consolidation didn't work. It just means that you had subsidized and unsubsidized loans, and those loans are kept apart because there are some situations where interest may or may not accrue. All right. You'll also notice that all other terms are the same. So the disbursement date on those 2 parts of the loans is the same. The interest rates, the payment counts, those are the same. It's just that the distinguishing factor between those 2 portions of your consolidation loan is that some of the underlying loans are subsidized, some of the other ones are unsubsidized. All right, let's take a look at our next question. Will the payments I made during an administrative forbearance count? Here we go again with the administrative forbearance. We know a lot of people that are in those types of forbearances right now. Here's a bit more background. This person was placed into forbearance while their income-driven repayment plan was getting updated. They made payments anyway. They have 2 payments left to reach 120, so that lets us know that this person is pursuing public service loan forgiveness, and they're estimated to reach that 120 payment milestone in April of this year. They requested not to be placed into a forbearance, but we're told that the issue would take 87 days to correct. The issue here is that while the servicer is trying to update their payment, this borrower does not want the payments that they've made applied to principal as if they had made an extra payment. So here again, it's where it's important to know the difference between certain types of forbearances. A voluntary forbearance is a forbearance that you as the borrower requested. And if you requested the forbearance, then under normal circumstances, any payments that you make during those months would not count toward public service loan forgiveness because your loans were in a forbearance of your choosing. However, an administrative forbearance is different because you didn't ask for this. This is something that the servicer placed your loans into because of some unresolved issues on their side that they're working through. So because the administrative forbearance is not one of your choosing, the time spent in administrative forbearance is supposed to count toward public service loan forgiveness. So if this borrower wants to make extra payments, payments aren't required while the loans are in forbearance. So if they make an extra payment, it would not count as a normal payment would, to my knowledge, because no payment was required, and the time in the administrative forbearance would count anyway. So if the concern is that the excess payment will be applied to principal, I just would not make the excess payment, because if the loans are in administrative forbearance, a payment's not required, and that was not by your choosing, so you should not be penalized for it. If you were to make excess payments that were actually due, and after you made those payments, it was found that you reached 120 months ago, those excess payments would come back to you in the form of a refund because the payments were actually required. But if you're just making payments at a time when no payments are required, I don't know that those payments would come back to you as a refund. They might be applied to the principal because the payments were not required. And under normal circumstances, if you make a payment that's not required, those payments would not count toward forgiveness. And if they're applied to the principal, you might not be able to get those back. So we'll have to see how this works out. But my personal recommendation would be, don't make any payments, because you're in a period where payments aren't required. And at the same time, the months that you don't make those payments are set to count. So if it's already set to count, there's no need for you to pay extra. Keep that money if you can. All right, let's move on to our next question. Do I need to recertify employment now that Mohela has approved my consolidation and assumed my loans? So this is another question about public service loan forgiveness. A bit more background here. This borrower had FELP loans, and they had already made more than 120 payments on those FELP loans that were held with Navient before they consolidated. The borrower consolidated in December of 2023, so late last year, and they also completed their employment certification at that time. Right now, they're still waiting for past payments to appear in the payment tracker. So we'll see what happens. But just keep in mind that consolidating in December of 2023 is pretty recent, and it can take the standard 90 business days for Mohela to get everything together and give you an accurate payment count. So we're at the end of March. They consolidated in December of 2023. This is right around the time when they should be hearing something. Just a reminder here about consolidating. When you consolidate, your repayment clock is temporarily reset to zero, because consolidation is paying off your older loans, and it is initiating a new loan for the exact same amount. But since it's a new loan, it's going to start over with zero history. So if that's the case, your first payment count might say that you have 1 or 2 months because the consolidation loan was recently dispersed, and that's all the history that they're going on. A second count usually comes within, I think we say 4 to 6 weeks. So we'll say within 60 days. And that second count usually includes an update, which reflects a more accurate qualifying payment count. So if you're concerned about your employment and whether it has been counted, don't be concerned if you just received that first really, really low payment count. That just means that they've looked at your consolidation loan. They have not considered your pre-consolidation history. Once that pre-consolidation history has been counted, you'll see that your payment count will increase to reflect the history that's attached to those older loans, which in this case were FELP loans. If it takes Mohela a relatively long time to work through this, and you actually make payments on the direct consolidation loan, once it's found that you reached 120 prior to consolidation, they would give you a refund on any payments that you made after the direct loan had been consolidated. Unfortunately, they do not give refunds on FELP loans. So if you reach the 120 milestone while the loan was still a FELP loan, none of the extra payments you made on the FELP loan would be eligible for a refund. The refund could come, though, after the loan became a direct consolidation loan. So you could continue to make payments and then wait for the refund, or you could reach out and ask about the administrative forbearance. Once they realize that your payment count has hit 120, they usually place you into that administrative forbearance fairly quickly. But one thing that we've learned about this process is that it varies quite a bit from borrower to borrower. But about the employment, because this question was about certifying employment again. If you just certified your employment in December, it's it's a little bit fast, but it could not hurt to do it again, because if you've made any payments on that direct consolidation loan, you'd want to get the refund. But the way to check and see if all of your employment has been certified is to go to the payment tracker. So once you log into mohela.com, you want to go to PSLF on that blue navigation bar and click the payment tracker. Once you scroll past all the text, you'll see payment counts, eligible payments, ineligible payments, and employment. And if you click on the employment tab, then you'll be able to see a list of the employers for which your employment has been verified, and you'll also be able to see the time frame. So check there to make sure that your employment is up to date and to make sure that you get credit for any payments you might have made on this direct consolidation loan. You might want to go ahead and update your employment anyway, just to maximize that count. Okay, next question. This is about correcting errors in employer names and dates. Is there a process to rectify this information, and will it pose any issues concerning forgiveness despite selecting or entering the accurate employers and dates? So once again, another question about public service loan forgiveness. Apparently, we had a borrower who logged in and saw that inside of the Mohela app, their employer's name is listed incorrectly. And the employer's name doesn't matter so much as long as the EIN is correct and you're getting credit for all of the time that you've worked there. The dates of employment are incorrect in that for the current employer, it says that they have an end date of August 2022, but they're still currently employed. So I think that what might be happening here is that the last time the employment was verified was August of 2022. Again, you can go to the payment tracker and look at the employers and then look at the dates of employment that you have verified. You'll be able to see the end date. So it's not necessarily that they think you're not employed there anymore. It's just that your employment may not have been verified since then. And so they haven't counted the payments yet. Key thing to remember about these employment verifications is that they're only valid up to the actual signature date of the employer on the form. So if you submitted a form in August of 2022, and that was the last time that you did that, then that is going to be the effective end date of your employment in Mohela's eyes. So you may need to go back, upload another PSLF application or complete it through the help tool and use DocuSign so that they can go ahead and update your employment. Just as a reminder for those of you that are pursuing PSLF, it's recommended that you complete that form annually, also whenever you change employers, and after you make your 120th payment, because Mohela has no means to update your actual employment without verifying it, because they don't know that you still work there until you send in a form with that more recent date. So my advice is to go back, look at the payment tracker, check and see on that employment tab if the dates are definitely there for that employer up to now or your most recent submission date for a PSLF application. And if you see that it ends on August of 2022, that just lets you know that that was the last form that you submitted. As a reminder with PSLF, it is so much better to complete the form electronically because there are shorter processing times, there is less opportunity for error, and it just takes away a lot of the uncertainty. When you use the manual signature for public service loan forgiveness, you're going to have to deliver that paper form to someone, whether it's by email or by hand. By email, you risk exposing personally identifying information like your social security number, as well as your birth date and your address. And it just, again, opens up the opportunity for more errors, because if someone checks the wrong box or doesn't sign in the right place, or writes something that's illegible, your application could be rejected, and it might take you a good 3 months to find out that the application is rejected. You can get around all of that by completing the form electronically at studentaid.gov/PSLF, and just making sure that you have an email address for the person within the organization who's willing to verify your employment. And like I said again, let DocuSign do what it's designed to do. All right, that was actually our last question. So as always, we like to wrap things up by giving information for Marylanders. Maryland is a state that has a student loan ombudsman, and the student loan ombudsman is there to assist you with any problems you might be experiencing with your servicer. And the problems that they can help with include failure by the servicer to communicate with the borrower, errors in crediting principal and interest payments, misapplied payments, inaccurate interest rate calculations, billing errors, loan consolidations or modification errors, and or inappropriate collection activity or tactics. You can reach the Office of the Student Loan Ombudsman through the state's Department of Labor. You can submit a complaint online, and perhaps they will open up an investigation. And there are also some informational resources out there about student loan repayment in general, as well as public service loan forgiveness. So again, you can reach out to the Student Loan Ombudsman online through the state's Department of Labor website. All right. That does it for the questions that came in ahead of today's broadcast. I just wanted to thank you so much for joining me for this edition of Office Hours presented by the Maryland Center for Collegiate Financial Wellness. We are online at mccfw.org. We are also on social media, including Facebook, X, the site formerly known as Twitter, Instagram, as at the MCCFW. We will work on getting this particular video annotated and uploaded by the end of the week. And the annotation will make it so that you can go straight to the content that matters most to you. If you do have a question, please do reach out to us through mccfw.org/contact. We're reviewing the contact form, but I do have to tell you, we are experiencing heavier than usual inflow of those queries because we have that IDR adjustment deadline that's coming up on April 30th. And so we are receiving lots of requests. And since we're receiving lots of requests, it's going to take us a longer time than usual to get back to you. But I still encourage you to connect with us online at mccfw.org. I thank you so much for your support with Office Hours. If you would like to support the center in another way, you can do so by staying engaged on those social platforms at the MCCFW or making a donation online at mccfw.org/support, as the Maryland Center for Collegiate Financial Wellness is a 501c3 nonprofit organization. And your support definitely helps us continue on this mission to empower students and families, help them build financial life skills, and give them the opportunity to thrive. So I'm going to check one more time to see if we have any questions that came up during the broadcast. Pardon me while I look at my phone. I'm not seeing anything at the moment. If you have a question that comes up afterwards, please do reach out again. You can tag us on socials as at the McFew, at the MCCFW, or you can reach out to us by way of the contact form, which is mccfw.org/contact. And since we don't have any questions at this time, I'm going to go ahead and wrap things up. I hope that you all are having a lovely day, and I appreciate your engagement. We'll look forward to seeing you again next time for Office Hours coming up in April. April is also Financial Literacy Month, so be on the lookout for lots of programming from colleges and universities across the state. One last thing that I forgot, we did have a new podcast episode drop. This one is about unlocking opportunities for undocumented students, featuring Gustavo Minaya. He is a financial aid outreach counselor at Montgomery College, and he's also the founder of Mi Futuro Education. And Gustavo immigrated here from Peru at the age of 6 and ended up getting into higher education originally to pursue his degree, but then ended up staying in higher education and has used both his personal experience as an undocumented student and his professional knowledge in financial aid and admissions to help more undocumented students get the access to the aid that they are eligible for. So you can visit us online at mccfw.org/podcast to take a listen to that episode featuring Gustavo Minaya. I will check one last time to see if we have any comments or questions that came through. And as of right now, there are none. So thank you again for your engagement with us during office hours. We truly do appreciate your support, and we will see you next time. Until then, be well. Bye-bye.